Something felt off long before the headlines started appearing. On the morning the sell-off began, gold wasn't reacting the way gold normally reacts. Inflation expectations were rising. Bond yields were unstable. Geopolitical tensions were simmering in multiple regions. Under normal conditions, gold should have been climbing quietly, steadily, almost predictably. Instead, within minutes of the New York trading session opening, a wave of selling hit the market so large and so sudden that traders watching live order flow described it as a wall. Not a gradual decline, not profit-taking, a wall. Thousands of futures contracts dumped into the market in seconds. That kind of volume doesn't come from retail traders. It doesn't come from pension funds adjusting positions, and it certainly doesn't come from long-term holders who understand how precious metals behave over cycles. It comes from institutions with enough leverage to move markets deliberately. Within 15 minutes, gold had dropped sharply. Silver followed even faster, falling with exaggerated volatility, as it often does when liquidity disappears. Stop-loss orders triggered automatically. Algorithms accelerated the move, panic spread across trading desks and social media simultaneously. But the deeper question wasn't why prices fell. The real question was why someone would choose to sell that much, that fast, in a way that guaranteed the worst possible price. Any experienced trader knows, if you want to exit a large position, you do it slowly, quietly, over time. You don't slam the market unless your goal isn't to sell efficiently, but to move the price itself. That distinction is where the conversation begins, because what unfolded over the following hours revealed patterns that many analysts have seen before. Patterns that don't prove manipulation on their own, but when combined, form a picture that's difficult to ignore. First came the paper selling, massive futures contracts flooding the market, representing metal that didn't physically exist in vaults ready for delivery. This isn't unusual in commodities markets, but the scale matters. The ratio between paper contracts and physical metal has grown to levels that would have seemed impossible decades ago. In practical terms, this means price discovery isn't always driven by real supply and demand. It's driven by financial instruments, leverage, and institutional positioning. And when leverage dominates, price can be pushed, at least temporarily, in directions that defy fundamentals. Within hours of the crash, another signal appeared. Physical bullion dealers in several regions reported something unexpected. Demand was rising, not falling. Buyers weren't scared away by the drop. They were rushing in. Normally, a true collapse in an asset destroys confidence. Demand evaporates. Inventories sit untouched. But this time, premiums on physical coins and bars began rising even while the spot price was falling. That divergence tells a story. Paper markets were collapsing. Physical markets were tightening. Two different realities unfolding at the same time. And that's when the larger implications started to emerge. Because gold and silver aren't just commodities. They're monetary metals. They reflect trust, or the lack of it, in currencies, in governments, in central banks. When precious metals rise steadily, it sends a message that investors are seeking protection. When they fall suddenly and violently, especially without a clear macroeconomic trigger, it raises questions about what forces are at work behind the scenes. Consider the timing. The crash occurred just as several economic indicators were pointing toward renewed monetary easing in major economies. Central banks were facing pressure to cut rates again. Debt levels were climbing. Currency volatility was increasing. Historically, those conditions are bullish for gold. Yet the price moved in the opposite direction, at least in the short term. For experienced market observers, this wasn't the first time such a pattern had appeared. There have been previous episodes where metals dropped sharply during moments when, logically, they should have strengthened. Each time, the explanation offered publicly was the same: profit-taking, technical corrections, shifting expectations. But inside trading circles, the discussion often sounded different. Traders would talk quietly about price management, about large entities defending key levels, about the unwritten understanding that certain signals in the financial system must not be allowed to flash too brightly. Because gold rising rapidly sends a message, and sometimes that message isn't convenient. What made this event different, however, was the scale and the speed. The magnitude of contracts dumped into the market exceeded typical liquidation events. Liquidity gaps widened dramatically. Several smaller trading firms were forced out of positions entirely, and while prices eventually stabilized, the damage had already been done, not just to portfolios, but to confidence. Investors began asking questions. Why did the selling occur at that exact moment? Who had the capacity to execute trades of that size? And most importantly, what happens next? Because markets don't move in isolation. A shock in precious metals often signals stress elsewhere. Gold and silver are like pressure gauges in a vast financial machine. When the needle jumps violently, it usually means something deeper is shifting beneath the surface. In the days following the crash, attention turned to bond markets. Yields were fluctuating in unusual ways. Currency markets showed signs of instability. Central bank communications became more cautious, more measured, almost as if policymakers were aware that the system was more fragile than it appeared publicly. And that's the part many casual observers miss. A single market event rarely matters on its own. What matters is what it reveals. The metals crash revealed how dependent prices have become on leverage and derivatives. It revealed how quickly liquidity can disappear, and it revealed how disconnected paper markets can become from physical reality. But most of all, it revealed something about psychology, because fear spreads faster than facts. Retail investors saw prices falling and assumed something fundamental had changed. Many sold near the bottom. Others stayed frozen, unsure whether the decline was temporary or the beginning of something larger. Meanwhile, institutions with long-time horizons began quietly accumulating positions again, often at lower prices than just days earlier. That pattern, panic selling followed by quiet accumulation, has repeated throughout financial history. It happened in equity markets, in housing markets, in commodities. And it often happens when information is unevenly distributed. The question now isn't whether the crash happened. Everyone saw it. The charts are clear. The headlines are archived. The real question is whether it was the end of a cycle or the beginning of one, because markets sometimes shake out weak hands before making their biggest moves. They create volatility to reset positioning. They move violently in one direction, only to reverse months later with even greater force. And if that's what this event was, if it was a reset rather than a collapse, then the most important phase may not be behind us. It may be ahead. After the shock faded and the charts stopped bleeding red, the conversation began to shift. At first, analysts on financial television framed the move as a routine correction. They pointed to rising bond yields, a stronger dollar, and profit-taking by hedge funds. Those explanations sounded reasonable on the surface. Markets move for many reasons, and sharp corrections do happen. But in the weeks that followed, something didn't fit that narrative. If the crash had been driven by a genuine change in fundamentals, demand should have weakened across the board. Instead, reports from bullion dealers, refiners, and wholesalers told a different story. Inventories were tightening in several regions. Delivery times lengthened. Some popular silver products went temporarily out of stock. That divergence, the difference between paper price and physical demand, became impossible to ignore. And that's when a deeper realization began to spread among investors who pay close attention to monetary history. Sometimes a price drop is not a reflection of falling demand, but a reflection of stress inside the financial system itself. Because gold and silver don't exist in isolation. They sit at the intersection of currencies, debt, interest rates, and geopolitical risk. When those forces begin to shift simultaneously, the effects ripple outward in unpredictable ways. To understand what the crash may have been signaling, you have to look beyond metals and examine the larger structure of the global economy. Right now, the world is carrying more debt than at any point in modern history. Governments have borrowed heavily. Corporations have leveraged balance sheets. Consumers in many countries are stretched by higher living costs and rising interest payments. Debt itself isn't the problem. The problem is servicing that debt when interest rates remain elevated for long periods. Central banks are trapped in a narrow corridor. If they keep rates high, they risk slowing economies sharply and triggering financial accidents. If they cut rates too quickly, inflation could reaccelerate and undermine confidence in currencies. That balancing act is becoming more difficult with each passing quarter, and historically, when confidence in monetary policy weakens, investors begin looking for alternatives. That's when precious metals tend to move, not gradually, but decisively. But before major moves happen, markets often experience volatility designed to shake out speculation. Weak hands exit, leveraged positions unwind. Sentiment turns negative. Only then does the trend reassert itself. Several veteran traders have described this phase as the quiet reset, a period when prices appear weak even as underlying pressures are building. There's another factor few people talk about openly: the role of liquidity. Financial markets today are deeply interconnected. When stress appears in one sector, whether it's bonds, real estate, or equities, large funds sometimes liquidate other assets simply to raise cash. It isn't about their view on gold or silver, it's about survival and balance sheet management. That kind of forced selling can create violent price moves that have little to do with fundamentals. And once those moves begin, algorithms and momentum strategies amplify them. High-frequency systems react in milliseconds, accelerating trends in ways human traders never could. A decline that once would have unfolded over days can now happen in minutes. The metals crash carried many of those signatures: sudden liquidity gaps, cascading stop-loss triggers, and rapid rebounds once selling pressure eased. Those patterns suggest a market reacting mechanically rather than fundamentally. But the most important signal wasn't in the price action itself. It was in what happened afterward. In the weeks following the crash, central banks in several countries continued quietly increasing their gold reserves. That trend has been building for years, but it accelerated recently. Nations that once relied heavily on dollar reserves have been diversifying, adding bullion to their balance sheets. Central banks don't buy gold for short-term speculation. They buy it as a hedge against systemic risk. That behavior sends a message, even if it isn't stated publicly. It suggests that institutions responsible for managing national reserves see potential instability ahead. At the same time, geopolitical tensions remain elevated. Trade relationships are shifting. Alliances are evolving. Sanctions and currency restrictions have made some countries reconsider how they store and protect wealth at the national level. Gold, unlike currencies or bonds, carries no counterparty risk. It cannot be frozen by another government. It does not depend on a banking system to exist. Those characteristics matter more during uncertain times. Silver, meanwhile, occupies a unique position. It's both a monetary metal and an industrial one. Demand for electronics, solar panels, and advanced manufacturing continues to grow, placing structural pressure on supply chains. Mining output has struggled to keep pace in certain regions, and new projects take years to develop. That means silver's long-term fundamentals are influenced not just by investment demand, but by the real economy. When both monetary and industrial demand align, price movements can become dramatic. That possibility is what many long-term investors are watching now, because the crash may have accomplished something important. It reset expectations. It cooled speculative enthusiasm. It allowed large players to reposition quietly while public attention shifted elsewhere. Markets often move in cycles of attention. When everyone is talking about an asset, it's often near a peak. When interest fades and headlines disappear, foundations are sometimes being built for the next major move. Right now, precious metals are no longer dominating daily financial news. The drama has moved on to other sectors, and that silence itself can be significant, because major trends rarely announce themselves in advance. They develop slowly, almost invisibly, until one day the move becomes impossible to ignore. The larger risk isn't necessarily a metals crash. It's the possibility of a broader financial repricing, one driven by debt levels, currency volatility, and shifting global power structures. If that kind of repricing begins, gold and silver won't just react, they could become central to the story. And that's why experienced investors pay attention not just to price, but to behavior. Who is buying, who is selling, and what conditions are changing beneath the surface. The crash was dramatic. It captured attention. It triggered fear, but fear often obscures the deeper signal, because sometimes the most important events in markets are not the moves themselves, but what those moves are preparing the system for next.